Thus, well-known Tesla bull Cathie Wood deceived Tesla by acquiring GM stock after seeing GM CEO Mary Barra in the previous year. However, based on the most recent information regarding General Motors, Cathie's treachery will come at a heavy price. This morning, fresh data has surfaced indicating areas of significant difficulty for the carmaker. These difficulties might be a precursor to more significant problems later this year and in the upcoming decade. The collapse of GM is imminent, and Cathie's $13 million investment might be lost. When Cathie bought GM shares for the first time a year ago, renowned financial expert Jim Cramer called this and said, in Cramer's own words, that Cathie's backing for GM would be a kiss of death for the corporation. But press that like and subscribe button before we delve any farther. For now, the bulk of its paid employees in the United States are being offered buyouts by the DM. That is only the beginning of what the carmaker company is hiding. In essence, DM wants to save roughly $2 billion this year, and one way they want to do this is by giving workers the option to resign. Other manufacturers have demonstrated this, and GM just stated a week and a half ago that it will be eliminating roughly 500 wage positions globally. Nearly all of the company's paid employees are now receiving offer letters. It remains to be seen how many employees will accept the buyout and whether this will prevent the business from needing to start more widespread layoffs. Allow me to explain what I believe is happening in light of GM's Q4 earnings results. Every quarter, their sales in North America remained stagnant, but there was a rise in the accumulation of inventories in the same area. This indicates that even though the dealership's inventory increased, they sold the same amount of cars. Essentially, even though GM acknowledged it as a sale in their earnings report, the net sale of automobiles sold to customers in Q4 was lower than in Q3. Their sole activity involved transporting stock from their manufacturers to the dealership network. Dealerships are overstocked, particularly with regard to cost. In contrast, Chevy had a good 60-day supply of inventories back in November. Since then, the car industry has sadly been slowing down, and things don't appear good for GM. There is a serious issue at hand. Because dealerships were overstocking their best-selling truck, GM was forced to halt production of the vehicle. In actuality, people are just purchasing fewer automobiles, despite the narrative portraying this as rising production amid steadying demand. Since SUVs and trucks account for the majority of DM's revenue, this is a precarious situation. The one product that generates the most money is being put on hold. The most costly cars on the market are pickup trucks, which are the lifeblood of legacy automakers like GM. This does not look good for Cathie's money from ARK Invest. Cathie Wood's ARK Investment Management bought 158,187 shares of General Motors GM in 2022 for its ARK fund dedicated on autonomous technologies and robotics. This acquisition marked a departure from Wood's earlier criticism of traditional automakers. The transaction was revealed in a report that included the latest trades made by the company. According to Forbes, Wood, a well-known stock picker who specializes in early-stage technology companies, oversees over $60 billion in assets through her company, ARK Investment Management. Wood has voiced her appreciation for General Motors' advancements in electric vehicles and autonomous driving technologies, particularly its Cruise subsidiary situated in San Francisco, despite her prior criticism of traditional automakers. In a recent interview with Yahoo Finance, Wood discussed his meeting with GM CEO Mary Barra, mentioning that they talked about the company's electric vehicle initiatives and that the firm was thinking about investing in GM while keeping an open mind. Wood highlighted GM's emphasis on Cruise automation and Barra's attempts to turn the firm around as examples of how important it is to have an open mind and recognize success. Compared to her past criticism of GM and Ford's plans for electric vehicles and her forecast that they might go bankrupt, this is a significant change. Returning to GM in the present state of the economy, it is difficult to overlook the significant slowdowns and job losses that are anticipated for businesses such as GM. Slowdowns are unavoidable, but what's really important to know is when the next cycle will start and how it will impact auto manufacturers. I think there are two obvious candidates for the next cycle: attractive electric vehicles and reasonably priced automobiles. Affordability is becoming a major worry as a result of the Fed raising interest rates and consumers finding it difficult to make ends meet. It should come as no surprise that Tesla was the only automaker in the US to see annual growth in 2022. We've only just begun to see a noticeable transition away from gas-powered vehicles and towards electric ones. But there's also a big market for reasonably priced vehicles, especially electric vehicles. Automakers run the risk of falling behind if they are unable to supply this. So amid all of this, where does DM stand? Sadly, it appears that they are having problems. Although the Chevy Bolt is one of the more reasonably priced EVs available, it is not without its problems. Due to the car's several recalls, the purchase was a bad one for the buyer. It's obvious that GM needs to adapt and produce attractive, reasonably priced EVs if they want to stay relevant in this shifting market, especially with layoffs and production pauses imminent. Affordable vehicles from DM, such the $45,000 Blazer EV, and the approximately $30,000 Equinox EV, which arrive on sale in the autumn of 2023, could enable them to meet their objective for their next vehicles, which include the Lyriq, Blazer, Equinox, and Silverado, and are anticipated to go on sale in 2024 and 2025. They must nevertheless increase production. In the competition to create an EV that is affordable for the general public, Tesla is far ahead of the pack. When the carmaker's future inexpensive electric vehicle goes on sale, Elon Musk, CEO of Tesla, says it will mostly function in autonomous driving mode. Musk stated that a low-cost electric vehicle EV would be developed in 2020 with a target price of roughly $25,000. At Tesla's most recent investor day, no information on the car was provided, despite investor expectations. However, Musk recently gave a status report on the vehicle in an interview at the Morgan Stanley gathering. He clarified that the company's plan is to produce a smaller car that will almost entirely run on autonomous power and cost roughly half as much as the Model 3. Tesla needs autonomy, and Musk noted that the company's greatest achievement to far is the quick development of the full self-driving system. As seen by her evolving position on GM and legacy automakers, Jim Cramer, a well-known CNBC anchor and personality known for his frank judgments on people and equities, claims that Cathie Wood has a history of altering his thoughts. Wood just made her first acquisition of shares of General Motors after cutting back on her investment in Tesla incorporated a well-known manufacturer of electric vehicles. Cramer talked about the underperforming stocks of General Motors and Ford Motor Company last week on CNBC, but he was cautious to suggest buying General Motors because he thought Cathie Wood's involvement may have a negative effect. GM is doing fairly well. I believe Cathie Wood to be the kiss of death, Cramer remarked throughout. A recent episode of CNBC during a recession, Jim Cramer advised investors not to buy General Motors stock since it would probably take further substantial drops in value before bigger investors started buying the stock. He used prior examples of Warren Buffett making purchases during market lows as support. These comments come after Cramer's previous attacks on Palantir Technologies, a stock linked to Cathie Wood, which he disregarded, claiming that the firm probably wouldn't have drawn much attention if Wood hadn't been involved. Jim Cramer suggested to his audience on a Mad Money show in January to short Cathie Wood and think about purchasing the Total Capital Short Innovation ETF, which is intended to wager against Wood's primary ARK Innovation ETF. He attacked ARK for having a drowning scene in the show and for being the ultimate hedge fund that held traditional growth equities. On social media, though, a lot of people were eager to draw attention to Cramer's earlier remarks, which were made less than a year ago, in which he called Wood a genius at the height of her ETF's performance. Eric Balchunas, a senior analyst at Bloomberg, noted on Twitter that Wood's ETF had dropped by 50% since Cramer's February 2021 proposal, highlighting the irony of his advice. Cramer recommended that instead of making any more investments in ARK funds, Wood focus on enhancing performance. One reason why traditional automakers are finding it difficult to switch to EVs could be early insufficient investment in reasonably priced EVs. With its significant investments in low-cost EVs, Tesla might become the market leader. It's unclear how long GM and the EV business will remain profitable, and their futures are clouded. How do you feel about these matters? Please feel free to leave your comments below. Don't forget to like and subscribe. We appreciate your time, and we'll see you in the upcoming video.